Welcome to Breaking News to Trading Moves. Today we're focused on the recent performance report from Wells Fargo. We're using it as a lens, really, to look at the pressures and the opportunities across the whole financial sector.
And we can get right to it. This was what you'd call a mixed quarter for the bank. You had rising interest revenue, which is good, but the story and the market reaction were all about expenses.
Yeah, that expense headline really did grab the spotlight. Wells Fargo missed quarterly profit estimates, and the market reaction was, well, it was immediate. Shares fell about 4.6% on the day.
It did.
And when a bank that size moves like that, it tells you people are watching the execution very closely.
Oh, absolutely. And the reason was so specific. $612 million in severance costs.
From job cuts.
Exactly. It's all tied to their plan to streamline operations. I mean, all the banks are telling investors they're getting leaner, more digital. But this quarter shows that efficiency has a pretty steep upfront cost.
A cost that markets are not willing to just look past.
Apparently not, even if it's a one-time thing.
Right. But let's balance that, because there was some good news. Net interest income, the NII, was actually up year over year. That's the core engine, right? The spread between what they earn on loans and pay on deposits.
You're right. NII is the absolute engine for any bank, especially with rates where they've been. Wells Fargo said NII was up 4% to $12.33 billion.
Which on its face sounds pretty strong.
It does. But, and this is the key part, that number still fell a little short of what analysts had been modeling.
Okay, so hold on. If NII is up 4%, why did the market get so fixated on the $612 million in expenses and a slight NII miss? I mean, shouldn't the underlying business strength matter more than a one-off charge?
That's where it gets a little more complex, and it's all about something called duration mismatch. For anyone listening, NII really shows how well a bank can reprice its loans higher and faster than what it has to pay for deposits.
Got it.
And as competition for deposits got more intense, banks had to start paying more to keep customer money. So when Wells Fargo's NII came in just under expectations,
it hints that their funding costs, what they pay you and me for our deposits, are getting a little sticky.
Exactly. They're rising faster than the market hoped. And that raises questions about future margins. You combine that with a surprise expense item, and you get a double hit to sentiment.
So it wasn't just about the last 3 months, it was about the road ahead. I know Wells Fargo also gave some longer-term guidance for their NII, pegging 2026 at about $50 billion.
Precisely. And that $50 billion was also just a little bit under the average Wall Street estimate.
So you've got a trifecta, in a way.
In a way, yeah. You miss on expenses now, you come in a little light on NII now, and then you project a slightly softer revenue number for 2026. The market starts to question the whole growth story.
Okay, that makes sense. So this report really highlights some key themes for the whole sector.
Right.
What are the big two that every bank is dealing with right now?
The first one is that big efficiency drive we've been talking about. Every major bank is committed to, cutting costs to fund growth. That means headcount reductions, more automation, and a lot of investment in AI.
And the second theme is an external one, right? It's about political risk that could change how they make money.
Right. We're seeing proposals out there for new regulations. Specifically, there's talk of a 10% cap on credit card interest rates. This isn't just noise. It would hit the core of consumer lending.
Yeah, that feels like a big one. For anyone listening who might own shares in a credit card company, how would a 10% cap actually work? How would it affect their bottom line?
Well, right now, a lot of credit card APRs, the annual percentage rate, can be in the low to mid-20s, maybe even higher. That rate lets them lend to a broader group of people because the return covers the higher risk of default.
Okay.
If you suddenly cap that rate at 10%, the whole risk calculation changes overnight.
The room for error just evaporates.
Completely. Profitability on those revolving balances people carry would get squeezed hard. To make any money, they'd have to tighten their lending standards way up, only giving credit to the safest borrowers.
Which would mean less lending overall.
A lot less. It would shrink the consumer credit market and directly hit the revenue of companies that are really focused on cards, like a Capital One or a Discover.
So, looking forward, what are the key things you'd be watching over the next few quarters to really gauge the health of the sector?
First thing is that trend we talked about, NII versus deposit costs. You want to see who is holding on to their margin power, who can keep their funding costs down. That's going to be the real tell.
Second would have to be expense discipline, which is what started this whole conversation.
It's critical. We need to watch what's called the expense runway. That's just the time it takes for those big upfront costs, like the severance money, to wash out of the system.
So the new lower cost structure can finally show up on the books.
Exactly. Until that runway is clear, the market's going to stay skeptical.
And the third area is that external risk, monitoring any real movement on credit card APR policy.
Yep. That's a regulatory risk you have to keep an eye on. Any step toward making that 10% cap a reality changes the long-term profit model for a big part of the industry.
Okay, let's use these themes to pivot a bit. Let's talk about the market winners. Who actually benefits from this environment?
Well, the first group is pretty clear. The big banks that have strong NII leverage. These are the institutions with huge scale and low-cost funding. They can just control their deposit costs better than smaller players.
And their size helps them be more disciplined. So we're talking about the giants here. JP Morgan Chase.
That's JPM, and you have Bank of America, which is BAC.
And Citigroup, ticker C, is in that group as well.
They are. They all have these massive retail deposit bases, which are just cheaper funding sources. Their ability to hit NII targets gives them a real leg up right now.
Now, the second category of winners comes right out of that efficiency push we mentioned, bank automation and enterprise AI providers.
Yep.
Wells Fargo said they're investing in AI to modernize everything. That spending has to go somewhere.
This is where you look at who the banks are paying for that tech. I mean, a bank the size of Wells Fargo isn't building its own cloud from scratch. They're buying services from the big established leaders.
Can you give us a specific example? Like, what is a bank actually buying from these companies?
Sure. Take Microsoft.
Yeah.
MSFT. Banks are buying their Azure cloud services for data processing and running AI models for things like fraud detection. They're using ServiceNow
Which is NOW.
to automate internal workflows, which cuts down on headcount needs. And then you have Amazon, AMZN, with AWS, which provides the basic cloud infrastructure for a ton of financial data. These are the companies selling the digital picks and shovels.
That makes it much clearer. Okay, the third category is more of a bet on the future. Mortgage and housing rebound plays.
This one is all about what happens if the Fed starts cutting rates and the housing market picks up. The material pointed to the potential upside from more mortgage applications if and when rates drop.
Yeah, even a small drop in mortgage rates can unlock a lot of buying activity. That's a tailwind for anyone in that space.
And that's where you look at the big mortgage originators like Rocket Companies, RKT, and UWM Holdings, UWMC.
And even home builders like D.R. Horton.
All right, DHI. They would all see demand jump as homes become more affordable. This is really a bet on the direction of the economy.
All right, let's flip the coin and talk about the market losers. Who's facing pressure from the issues we've identified?
Well, the most obvious one is our starting point, Wells Fargo, with its near-term execution and guidance risk. The missed quarter, the NII miss, the soft guidance, it all creates doubt about management's ability to forecast and deliver.
And that pressure isn't unique to them. It would extend to other places that are also in the middle of a big restructuring or dealing with regulatory stuff, maybe like a U.S. Bancorp, ticker USB.
Absolutely. The market wants clean, simple quarters right now. Any bank that shows expense issues or a cloudy long-term view is going to be vulnerable.
The second group of losers faces that very clear risk we talked about. Credit card lenders exposed to pricing caps.
This is a direct shot at their business model. As he said, a 10% cap would just crush profitability for issuers who rely on those higher APRs. You look at a company like Capital One.
Ticker COF.
Their whole game is about managing risk and return across different APRs.
So they're stuck. They either have to accept way lower margins or they have to tighten up lending, which kills their growth.
That's the squeeze. And it's why issuers that are really centered on credit cards like Capital One, Discover Financial, DFS, and Synchrony, SYF, are more exposed than a diversified bank like JPM.
And the third category brings us full circle back to the initial expense problems, financials with elevated restructuring and operating cost pressure.
This is that messy middle period. When you decide to cut jobs and go through a digital transformation, you create this temporary fog of uncertainty. You've got these big severance costs, ongoing tech spending.
And a lot of questions about when the savings will actually show up.
Exactly. Markets hate that kind of ambiguity. They tend to punish the stock until there's proof it's working.
So this obviously includes Wells Fargo again, WFC, but also others like PNC Financial Services, PNC, which is navigating its own operational restructuring.
These are the names that have to prove it. They need to show that the costs of all this change can be absorbed quickly and that a leaner, more efficient company emerges on the other side.
That focus on the time to results really gets to the final thought, doesn't it? The big question that this report poses for all the major banks seems to be this. How quickly can the efficiency gains from all these job cuts and AI investments overcome the upfront costs?
That speed is everything, is what will determine the market viability of their strategies. And it's probably the single most important metric for you to track going forward.
That gives you a clear framework for looking at the financial sector. Thank you for walking us through all of that.
My pleasure.
And as always, please remember this. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.